What if I told you that the biggest risk to your financial future isn't a stock market crash, a housing bubble, or a global recession? What if the real danger is something much more quiet, much more deliberate, and it's happening inside your bank account right now? Imagine waking up tomorrow morning, opening your mobile banking app, and seeing that your balance is exactly the same as it was yesterday. You see the exact same numbers. But when you walk outside to buy groceries, fill up your gas tank, or pay your rent, you realize those numbers don't work anymore. You suddenly need twice as much money just to survive. Your numbers didn't change, but your wealth was completely destroyed. This isn't a hypothetical horror story. This is the exact financial trap that billionaire investor Ray Dalio, the legendary founder of Bridgewater Associates, warns is closing in on the American middle class right now. For decades, the standard American dream taught us a simple formula: work hard, pay your taxes, and put your leftover savings into a traditional bank account or a safe retirement fund. We were told that cash equals security, but in the current economic paradigm, Ray Dalio has issued an ultimatum that every everyday investor needs to hear: cash is trash. Right now, the value of the US dollar is being systematically diluted. When the government prints trillions of dollars to sustain an unpayable national debt, they aren't creating new wealth, they are stealing the purchasing power of the money you already work for. If your money is sitting in a standard savings account, you are safely losing your wealth every single year. You are bleeding to death financially, and the mainstream media is telling you everything is fine. But here is the good news. You do not need $1 million, a Wall Street broker, or an Ivy League degree to escape this trap. In fact, Ray Dalio has proven that you can protect your wealth, beat inflation, and position yourself to profit even if you only have $1,000 to start with. What you need is not more money. You need a system. You need a blueprint that doesn't try to predict the future, but instead builds a fortress around your capital that can survive any economic storm. In this video, we are going to break down Ray Dalio's exact $1,000 all-weather blueprint. We will look at pure historical data to show you how the global economic machine is shifting, why traditional investing advice is failing, and step by step, exactly how to allocate a single $1,000 stack into a resilient, uncrushable portfolio using low-cost modern tools. This is the ultimate guide to financial survival in the new world order. Let's decode the machine. To understand how to protect $1,000, we first have to understand the fundamental flaw in how most Americans invest. If you ask the average financial advisor on Wall Street how to protect your money, they will give you the classic time-tested advice: build a 60-40 portfolio, 60% in broad market stocks, and 40% in government bonds. For 50 years, this was considered the gold standard of diversification. The logic seemed flawless. When the economy grows, your stocks skyrocket. When the economy enters a recession, your stocks drop, but your bonds rise to cushion the fall. It sounds perfect on paper, but Ray Dalio discovered a massive hidden flaw in this traditional setup. He realized that a 60-40 portfolio isn't actually diversified at all. While 60% of your actual dollars are in stocks, stocks are roughly 3 times more volatile than bonds. This means that 60% capital allocation actually accounts for over 90% of the total risk in your portfolio. If the stock market crashes, your portfolio crashes, no matter how many bonds you own. Your entire financial survival is completely dependent on one single economic environment: high-growth equity markets. Dalio terms this an expression of bias. Most investors build portfolios that only work when times are good. They are betting their entire future on a single weather forecast. But what happens when the weather changes? What happens when you enter an environment where both stocks and traditional bonds crash at the exact same time? We saw this nightmare scenario happen in 2022, and we are seeing the structural cracks widen even further today. When inflation rages, central banks are forced to aggressively raise interest rates. When interest rates skyrocket, stock valuations drop because borrowing becomes expensive, and existing bond prices crash because new bonds pay higher yields. The 60-40 portfolio gets absolutely obliterated from both sides. The safety net turns into a trap. This is where the genius of the all-weather strategy comes into play. Instead of allocating your portfolio based on equal dollars, Ray Dalio pioneered a concept known as risk parity. This means balancing your investments based on the amount of risk each asset class contributes. rather than the number of dollars you put into it. Dalio looked back at hundreds of years of economic history across multiple empires, and he identified that the global economic machine moves through four distinct seasons. Every economic environment in human history is driven by a combination of two factors: growth and inflation. This creates four clear macroeconomic regimes. Regime number one, rising growth, where the economy is booming and corporate profits are high. Regime number two, falling growth, which is a classic recession where demand drops and unemployment rises. Regime number three, rising inflation, where the cost of living surges and money loses its value rapidly. And regime number four, falling deflation, where prices collapse and economic output shrinks. No one on earth, not even the most sophisticated computers at Bridgewater Associates, can consistently and accurately predict when the economy will transition from one season to the next. Wall Street spends billions of dollars trying to guess the next market move, and most of them fail miserably. Ray Dalio's philosophy flips the script. He says, stop trying to guess the weather. Instead, build an all-weather vehicle. Design a portfolio that assigns 25% of its total risk to each of these four economic seasons. Because no matter what happens next, whether we hit a severe recession, hyperinflation, or an unexpected tech boom, one part of your portfolio will be performing exceptionally well, offsetting the losses of another, and ensuring your total wealth moves steadily upward with minimal volatility. Now, let's get practical. How do you take this multi-billion-dollar institutional strategy and apply it to a simple $1,000 capital stack? In the past, this was impossible for everyday retail investors. You needed massive capital to buy physical commodities, international bonds, and diverse baskets of stocks. But today, the financial landscape has completely changed. Through the power of low-cost exchange-traded funds, commonly known as ETFs, and the availability of fractional share investing on modern mobile platforms, you can build a replica of Ray Dalio's all-weather portfolio with just $1,000 sitting on your phone. Let's break down the exact capital asset allocation that Ray Dalio revealed to recreate this strategy. The framework requires dividing your $1,000 into 5 specific building blocks. Building block number 1 is your growth engine, stocks. You allocate exactly 30% of your capital to equities. Out of your $1,000, this means exactly $300 goes into the stock market, but you don't buy individual hype stocks or speculative tech companies. Dalio warns that trying to pick winning stocks is a zero-sum game where you are competing against institutional algorithms. Instead, you buy the entire market. For an American investor, the most efficient tool for this is a broad market index fund, such as the Vanguard Total Stock Market ETF, ticker symbol VTI, or an S&P 500 ETF, like VOO. By putting $300 into VTI, you instantly own a fractional piece of thousands of the most productive corporations in America. When the economy is in a high-growth, low-inflation season, this 30% chunk will be the primary driver of your portfolio's returns. Building block number 2 is your long-term insurance policy, long-term treasury bonds. You allocate exactly 40% of your portfolio here, which means $400 out of your $1,000 stack. To a beginner, putting 40% of your money into long-term bonds might seem counterintuitive, especially in a volatile rate environment. Why hold so much fixed income? Remember the principle of risk parity. Long-term bonds are far less volatile than stocks, so you need a larger dollar amount of them to balance the total risk contribution. Long-term treasuries perform exceptionally well during periods of falling economic growth and classic deflationary recessions. When panic hits Wall Street and the stock market collapses, institutional capital floods into safe haven U.S. treasuries, driving their prices up. The most liquid and efficient ETF to capture this exposure is the iShares 20+ year Treasury Bond ETF, ticker symbol TLT. This $400 allocation ensures that if the stock market enters a multi-year bear market, your portfolio has a massive structural cushion. Building block number 3 is your medium-term stabilizer, intermediate-term Treasury bonds. You allocate exactly 15% or $150 of your $1,000. This allocation bridges the gap between short-term cash and long-term volatility. Intermediate bonds provide a consistent, steady yield and perform well during moderate economic slowdowns without carrying the same level of interest rate sensitivity as 20-year bonds. The industry standard ETF for this block is the iShares 7-to-1 0-year Treasury Bond ETF, ticker symbol IEF. This completes the defensive fixed income core of your portfolio, bringing your total bond exposure to 55%. Building block number 4 is your ultimate protection against currency debasement, gold. You allocate exactly 7.5% of your capital, which equals $75 out of your $1,000. Ray Dalio has been one of the most vocal advocates for gold throughout his entire career. Why? Because gold is the ultimate timeless insurance policy against central bank incompetence. When governments face unpayable debts, they always choose to print money to inflate their way out. You cannot trust a paper currency because its supply can be expanded to infinity by the click of a button. But you cannot print gold. Gold has no counterparty risk, it cannot go bankrupt, and for thousands of years across every major civilization that has ever collapsed, gold has preserved its purchasing power. When inflation surges and people realize that their cash is losing value, they panic buy hard assets, causing gold to skyrocket. For a $1,000 portfolio, buying physical gold bars isn't practical due to high premiums and storage issues. Instead, you can use the SPDR Gold Shares ETF, ticker symbol GLD, or the low-cost IAU, which tracks the spot price of physical gold held in secure vaults. Building block number 5 is your shield against real-world inflation, commodities. You allocate the final 7.5% or $75 to a diversified basket of raw materials. While gold protects against the devaluation of the currency itself, commodities protect against the direct rising cost of real-world goods. This includes energy like crude oil and natural gas, industrial metals like copper and aluminum, and agricultural products like wheat and corn. When supply chains break down or geopolitical conflicts erupt, the cost of raw materials surges overnight. This real-world inflation crushes stocks and bonds, but it causes commodities to surge. The most effective way to hold this asset class is through a broad commodity index fund, such as the Invesco DB Commodity Index Tracking Fund, ticker symbol DBC. Let's look at the complete chassis of your $1,000 all-weather portfolio. You have $300 in VTI for growth, $400 in TLT for long-term safety, $150 in IEF for stability, $75 in GLD for currency protection, and $75 in DBC for raw material inflation. You have successfully mapped a multi-billion-dollar macro hedge fund framework into a simple $1,000 retail account. Where then was, but building the portfolio is only half the battle. To make the all-weather blueprint actually work over time, you must understand the mechanical discipline of rebalancing. This is where most retail investors let their emotions destroy their returns. Human psychology is hardwired to do the wrong thing in the markets. When stocks are on a massive bull run and hitting all-time highs, people feel greedy. They want to sell their boring gold and bonds and pour all their money into stocks right at the peak. Conversely, when the market crashes and everything is red, people feel terrified. They panic sell their assets at the absolute bottom just to stop the emotional pain. The all-weather blueprint removes human emotion entirely and replaces it with cold, automated execution. Over the course of a year, different asset classes will grow at different rates. If the stock market has a spectacular year, your $300 stock allocation might grow to $450, while your bonds might drop. Suddenly, your portfolio is no longer balanced. It has become stock-heavy and exposed to high risk. To fix this, Ray Dalio dictates that you must rebalance your portfolio on a strict periodic schedule, typically once a year or once a quarter. Rebalancing forces you to do the hardest thing in investing. Systematically sell a portion of the assets that have gone up a lot, and use that cash to buy more of the assets that have underperformed and are currently cheap. It forces you to mathematically buy low and sell high, completely ignoring how you feel or what the headlines on CNBC are screaming. Today, modern financial platforms allow you to set your target percentages 30, 40, 15, 7.5, 7.5, and with a single tap of a button on your phone, the app will automatically calculate the exact adjustments needed and execute the trades for you using fractional shares. Let's look at the historical data to see how this system actually handles real-world crises. Many critics argue that during a massive stock market bull run, the all-weather portfolio underperforms a pure S&P 500 index fund, and that is absolutely true. When equities are tearing upward, holding 55% in fixed income and 15% in commodities will hold back your maximum returns. But this argument misses the entire point of wealth preservation. The goal of the all-weather blueprint is not to maximize short-term greed, it is to guarantee long-term structural survival and eliminate catastrophic drawdowns. Think back to the 2008 global financial crisis. The S&P 500 collapsed by over 50%, wiping out a decade of middle-class savings and forcing millions of regular Americans to delay their retirement. Investors who were heavily concentrated in equities panicked and sold everything at a massive loss. But during that exact same historic crash, a risk-parity all-weather allocation experienced only a minor single-digit drawdown. While the equity portion was dropping, the massive 40% allocation to long-term treasury bonds surged as interest rates were cut to zero, and the gold allocation provided a powerful buffer. An investor using this blueprint slept soundly, didn't panic, and recovered their entire capital baseline almost immediately. The exact same resilience was demonstrated during the 2020 pandemic crash. When the market experienced the fastest drop in history, the all-weather vehicle stayed steady, providing a smooth, consistent, upward curve. Ray Dalio frequently emphasizes a profound investment truth. The nature of loss means that if you lose 50% of your capital, you don't just need a 50% return to get back to even, you need a 100% return just to break even. Most retail investors spend years making good returns, only to lose everything in a single market crash because they lack structural diversification. Eliminating big losses is infinitely more important than chasing big gains. As we look ahead into the remainder of this decade, the macroeconomic environment is becoming increasingly complex. We are entering what Dalio calls a global paradigm shift. The era of low inflation, cheap debt, and absolute geopolitical stability is over. We are seeing the rise of a multipolar world, massive domestic political polarization within the United States, and an unprecedented expansion of the global money supply. Central banks around the world are caught in a corner where they must continuously print money just to service the interest on their existing obligations. This means that currency debasement is not a temporary issue. It is a structural necessity for the survival of the current financial system. In this new paradigm, holding your wealth in paper cash is a guaranteed losing bet. The system is designed to inflate away the value of debt, which means it is designed to inflate away the value of your savings. But by taking action today, by taking even a small stack of $1,000 and organizing it into an uncrushable, risk-balanced multi-asset fortress, you step outside of the trap. You stop being a victim of the economic machine and you become a master of it. You build a system that doesn't care who wins the next election, what the Federal Reserve decides in their next meeting, or what happens to the inflation metrics next month. You build a blueprint that is structurally ready for whatever weather comes next. The economic machine is moving forward, and history has already written the script for how this cycle ends. The only question left is where you will be standing when the system resets. Take control of your allocation, eliminate your biases, automate your discipline, and protect your hard-earned wealth. If you want to continue decoding the financial machine, mastering macroeconomics, and tracking these massive market shifts before they hit your personal wallet, make sure to hit the subscribe button, leave a comment with your thoughts on Dalio's framework below, and share this analysis with someone who needs to hear this warning. Thank you for watching, and we will see you in the next analysis.